Besides the obvious risk of deposit outflows, there are several other ways in which blockchain will likely transform multiple areas of banking. In this part, we will discuss blockchain's impact on payments, loans and credit, escrow services and trade finance, know your customer processes, post-trade settlement, and other back-office operations. This isn't a short list, but all of the topics are really interesting, so let's get started. Billions of dollars are paid in banking fees each day. Some of these fees are clearly shown to customers and are for services rendered, while others are less obvious and arise when banks carry out operations related to foreign exchange, for example. It has been reported that global banks like Santander are vastly reliant on fees from international money transfers. An internal document which leaked in 2017 showed that these fees accounted for no less than 10% of Santander's revenue in 2016. On the other hand, once blockchain technology and some cryptocurrency solutions become mainstream, they will be the obvious first choice for such transactions. Cryptocurrency money transfers take less time and do not cost nearly as much as traditional bank transfers. Currently, at this early stage of the technology, Bitcoin takes from a few minutes to a few hours to process a payment. However, international bank transfers usually take at least 3 working days to settle. Other cryptocurrencies like Litecoin enable even faster and cheaper transactions, which can provide huge savings compared to the fees and time it takes banks to do the same. So national and especially international money transfers are a service that will likely be disrupted. In one of our earlier chapters, we discussed the reasons why bank transfers are so complicated, time-consuming, and expensive. They involve multiple intermediate steps, such as working with correspondent banks, and can suffer from long lines, exchange rate losses, counterparty risks, bureaucracy, and extensive paperwork. Blockchain solutions circumvent all these difficulties and are carried out on a peer-to-peer basis without the involvement of third parties. Naturally, this makes the process much cheaper and faster. Some banking officials have shown that they are aware of the potential disruption and are taking steps towards implementing blockchain solutions for international money transfers. A consortium of ANZ Bank, BNP Paribas, BNY Mellon, Wells Fargo, and Hyperledger developers have completed a proof of concept for cross-border payments built with the Hyperledger Fabric blockchain platform. It is designed to test whether moving member bank accounts to a distributed ledger could help the interbank payments platform SWIFT reconcile in real time. Hyperledger Fabric enables real-time visibility on the liquidity of Nostro accounts, easing reconciliation and allowing liquidity savings while meeting key industry requirements such as governance, data privacy, standardization, and identity management. Separately, in September 2017, the Royal Bank of Canada, RBC, started using Hyperledger for its U.S.-Canada interbank settlements. Okay, great. Moving on to the next line of business, the deposit-taking and credit-giving model consists of 2 parts. We already discussed the deposit side. Now let's talk about lending and the transformation it could experience in the future. Today, banks continue to be the main source of credit to people and companies. Peer-to-peer lending is a popular niche, but informational asymmetries impede its implementation on a large scale. P2P lending relies on a solid idea. If people deposit their funds in banks, and then banks use their customers' money to lend it to other people, doesn't it make more sense for depositors to lend their money directly to borrowers and earn a higher rate of return on their money? Banks seem to be a redundant middleman in this equation, don't they? Their main added value comes from the fact that they arguably have expertise in sorting out good from bad borrowers, and also specialize in dealing with bad debtors once they stop servicing their debt. It is more likely that in the future, platforms involving smart contracts will make things easier and more transparent. Informational asymmetries between borrowers and lenders will be reduced due to the clarity deriving from the blockchain. Pre-agreed terms will be respected, and there will be some sort of public database in which people will be able to see who's been a good borrower in the past and lend them money. Think of an online marketplace. Sellers and buyers in such marketplaces have ratings. Reputation is the very foundation for being successful in the long run. Well, imagine a world where borrowers will have reputation and all of their previous relevant actions will be recorded on the blockchain. This would certainly reduce informational asymmetries. Lenders would have more information regarding the type of borrower they are about to lend money to. Moreover, this information would be immutable and easily accessible. This would create a competitive market where lending services are easily accessible to people because they are less expensive and faster. Banks are burdened by huge administrative costs, which inflate the final interest rates they charge borrowers. In a P2P lending market facilitated by blockchain and smart contracts technology, lenders wouldn't have to cover nearly as many admin costs and would be happy to receive a fraction of the interest rates charged by banks. Another area blockchain will likely disrupt is trade finance and escrow services. In the world of today, there are many parties trading with each other but not trusting one another. Banks help ease such asymmetries by providing letters of credit and escrow services. Think of a retailer in Europe who wants to import clothes from China. He's managed to find a factory producing clothes and they provide a good price point for the first shipment. Its total value is €500,000, which is not a negligible sum. The problem is that the retailer hasn't worked with the supplier before and cannot be certain that the Chinese manufacturer will deliver the clothes once the money's been sent. At the same time, the Chinese manufacturer doesn't have a guarantee the European retailer will send the money once the goods have been shipped. Sounds like an impasse, doesn't it? Well, the solution that has been established as of now is to use an escrow account. The European retailer will deposit the funds in a trusted bank, which will then release the funds only when the producer has shipped the goods. In this case, the bank's reputation removes informational asymmetries on both sides and facilitates the trade. The bank guarantees with its name and regulatory license that the process will be as legitimate as possible. However, banks charge a percentage of the total transaction value for this service. Platforms based on smart contracts will certainly transform this line of business. The two parties in a business transaction will be able to design a mechanism that transfers the title to goods and money automatically. The conditions according to which the deal will take place will be programmed into a smart contract, and both parties can be certain that these are immutable and will be executed automatically. As you can see, plenty of exciting changes are coming our way, but there's more. In the current environment, banks have to engage in Know Your Customer or KYC processes. Authorities all over the world expect banks to collect information about their customers and verify their identity. The aim of these regulations is to prevent money laundering and impede the financing of crime and terrorist organizations. As you can probably imagine, this is a lengthy process. Some banks work with millions of clients and they have to fill in tons of forms and investigate any suspicious cases. This is a significant investment on their part. Every bank has to go through this process when it starts working with a new client of a certain size. A much more efficient way to do this would be to organize a unique distributed database, which can be shared among banks and regulators. In this way, they would be able to save themselves all the research effort that has been carried out by their colleagues. A decentralized blockchain solution would be optimal for these purposes, given that the immutability of records means client transaction history is stored in a secure and unbiased manner by all banks who share such blockchain platform. It would also increase transparency, but only to entities who have authorized access, as we believe such a solution is most viable to be implemented as a private, permissioned blockchain. Actually, such solutions are already being developed and tested. Here are a couple of examples. As of 2017, only 44% of Filipinos were utilizing bank accounts, a metric that is quickly increasing thanks to rapid economic growth in the Philippines, but is still hampered by inefficient mechanisms for checking the identity and history of new account applicants. Know Your Customer laws require asking for the same data over and over, much of which is not available in digital or verifiable form. To solve this, the Bankers Association of the Philippines, in partnership with Hyperledger and a coalition of major banks, undertook a proof-of-concept exercise. Its purpose was to build a prototype that implements identity verification using Hyperledger Indy. The platform streamlines onboarding of new accounts by allowing customers to enter information only once in a privacy-preserving way and reuse that data for new account opening. Banks can trust that the history of that data is solid. If successful, this could serve as a test for a nationwide ID system. In October 2017, another similar initiative by a consortium of a Singapore regulator and several banks, including HSBC and Mitsubishi UFJ, announced that they have completed a proof of concept for a KYC blockchain. The functionality, scalability, and security of the prototype were tested between February and May 2017. Results showed that the blockchain functioned well, even with a high volume of information flow. It proved to be tamper-resistant to third-party intervention while securing confidentiality by only allowing access to those with legitimate authentication. Similarly, bank offices will have a much easier time when blockchain is implemented in the context of post-trade settlement. An improved process, trusted by both counterparties, will reduce settlement times because both sides share and have control over the same distributed ledger system and can be certain that the prearranged conditions are preserved. Moreover, there will be less mechanical errors deriving from system failure. All market participants could share the same automated settlement system on the blockchain. Of course, all of this will lead to audit and reconciliation efficiencies too. Individual parties involved in a given trade will not have to do unnecessary replication of records and perform audits to ensure overall consistency. Ultimately, banks will be able to have leaner and less expensive back-office structures, which will work much faster. Okay, great. There are some impacts we expect blockchain technology will have on traditional banking business. Next, we'll discuss a case study about trade finance and blockchain. Thanks for watching.